This is Darcy Swan today. Lynn Schrader is on vacation and asked for me to serve as your hostess this morning. We've got a great webinar. I'm glad all of you are able to attend. As with all of our other webinars, if you have questions, please make sure you raise your hand in the space on the screen there with the GoToMeeting, or you go ahead and type your question in. I'll make sure that we get those questions answered. So today we're going to talk about long-term care and really kind of what the state of the union is of long-term care. And we're very honored today to have Rhonda Vrij-Bills with us, and she is with Long-Term Care Strategies. And what we're going to cover today is taking a look at the long-term care status. We're going to look at where sales are at, where the industry is headed, where the need really exists, what carriers are doing to position themselves, and what producers can do to work with their clients and making sure that they have the right products for them. We have got a great relationship going with Rhonda and her team there at Long-Term Care Strategies, and I'm going to let her do a little introduction of who Long-Term Care Strategies is and a little bit about that relationship, and then let her go ahead and move forward with her presentation. So Rhonda, do you want to go ahead and take it away?
Very good. Thanks, Darcy. Good morning, everybody, and thank you for the opportunity to take some time out to talk or listen to me today on the single largest unprotected liability that we face as a nation and actually other countries as well, and that is long-term care planning. This webinar is not so much on selling the need or the product designs, but it's more of just what do you as a broker need to know in regards to what's going on with the industry. As Darcy indicated, I've been working with KHI for several years now. My relationship with KHI is a lot of you specialize in health insurance, maybe do life insurance and some other products. You have a lot of clients that need access to long-term care, but maybe you're just not comfortable keeping up with this rapidly changing industry. So you have access to me and my organization, Long-Term Care Strategies. This is all I do. I've been in the industry since 1996 in specifically long-term care. And so you have a couple ways to work with me. If you say, hey, Rhonda, I wrote long-term care in the past. I only maybe do one or two, but I need your assistance in the back room, running the quotes, which products, underwriting. We can get you contracted, and then use me as your back support, and then you can write it and be the sole agent on your applications. Some of you don't even want to keep up with the partnership, the changes. They'd just rather pass the baton off and let me do what I do best, and I can do some joint work that way. And we split the business 50-50. So that's just a little bit, and obviously you can contact me later with more specific questions regard to that. So first of all, why we need a reboot is essential. What point is long-term care sales the tipping point? And we've definitely had lots of that going on here the last couple of years. Just to kind of give you a little bit of a trend, back in 2003, we were writing about 450 new policies were sold in the year 2003. Unfortunately, over the years, that number has gone down. For multiple reasons, those numbers have gone down. As an industry, the cost of care goes up. Why? The insurance premiums go up because the cost of care goes up. Number two, every year that we have more policyholders, we issue more claims. We have a good and better idea of what is going on with those claims, which conditions are yielding to which claims. We have more claims being paid out, so thus the underwriters are consistently changing their underwriting. It used to be I would have an underwriting guidebook and I could keep it for a couple of years. Now I don't even bother to get books. It's all electronic because I am getting notices all the time with, okay, we're no longer taking this condition, or we'll take this condition, but it's contingent upon A, B, C bullet points. So it's a rapidly changing industry. Unfortunately, the number of lives have gone down. In 2013, when I prepared this presentation here a couple months ago for today, we had about 172,000 lives that were issued in 2013. I did just get my long-term care source book. In 2014, we had just top 15 carriers wrote 133,660 policies. So that's quite the dip from back in 2003 with 450,000 policies were sold. I will say the good news, of those 15 top carriers that wrote 133,000 policies, 5 of those insurers actually had an increase of 50% in sales. So that is optimistic. So we talk about doom and gloom. There's always some good things to look forward to. But as a general, the standalone long-term care, I call it traditional long-term care policies, dropped by more than 23% in sales from the prior year in 2013. I'm going to guess some of you would like to know, hey, what's the average premium costing today? And the average premium for sales for 2014 was about $2,311. That is a single individual. Okay, so here, this slide, I'm just kind of giving you an idea of where we were at sales-wise as an industry. Obviously, sales continue to decline, again, for multiple reasons. The premiums are getting more and more expensive. The underwriting changes, and our market. Unfortunately, we still have a huge market. We still have 90% of the market that is untapped. So the need is out there. The cost of care is growing. I just had a client here I met with last week who had purchased a long-term care policy really by the encouragement of her financial planner. She wanted a basic policy. She didn't want to pay too much for it. 3 years later, her parents are needing care, and now she's saying, can I buy more insurance? So, a lot of times people are purchasing it, they know they need it, but they don't really have a grip until they see the reality cost of care. So what are we telling our producers? We're telling the producers we still have 70 million baby boomers that are coming, but what do they really hear? They're really hearing, we have a potential for, on long-term care side, there's potential rate increases. We know the need keeps growing because we have 70 million baby boomers. They're starting to retire. We know healthcare costs. I travel the state of Iowa, and I am consistently hearing cost of care, not insurance, but the reality cost of care is $6,000, $7,000, $8,000, $9,000 a month. I've heard $9,000 a month over in Davenport, Quad Cities. I've heard $9,000 a month in Boone, Iowa. So we know the need is still there. We know it's growing. We know this problem itself is not going away. We know that it's still a concern for family members. But as we're telling the producers that, in the back of their mind, what are they hearing? They're still hearing, oh, we've got all these companies that are coming out with enforced rate increases. We keep having higher and higher rates of declined applications. We have companies exiting the market. I would love to be able to tell every one of you that, those top A-rated companies like Prudential and MetLife and Allianz are still writing traditional long-term care, but I can't. They're still A-rated companies, but they have exited the long-term care industry, and of course that makes us often pause and reflect and say, what's going on here? What are we going to do? Do we really want to write our clients a policy if we know the company's not going to be around? So these are all things that we are concerning. The sales plunging. The claims denied, I would probably argue against that. Back in about 2007, particularly in Iowa, the Des Moines Register ran some articles stating about family members that were upset that their long-term care policies weren't paying. Well, what they really found out was, well, number one, they were wanting care on day one, and mom and dad had a 90-day deductible. Number two, they had an old policy written 30 years ago that was nursing home only, and these families were wanting to use it to put mom in assisted living, but the policy verbiage read nursing home only. And maybe they had a policy that paid $50 a day, but the reality cost of care was $100 or $150 a day. So when they got done evaluating everything, they really came back and found, and about that time all the companies came out with their claims experience, is about, I consistently saw 97, 98, 99% of claims that were submitted were actually being paid out. So even though we hear this claims denied, I would actually call that maybe experience or lack of knowledge or understanding of the family's actual policy itself. But you must have a way to convince people things are different. Whenever something goes wrong, I just push this little button and restart. I wish my whole life was like that. Often I can relate to this when, some of those major carriers like Allianz, Prudential, MetLife, they decide to get out of that. I just wanted to push the whole restart button. All of us in the insurance world knows we do consistently have to push the restart button and start again. But what can we do? We just have to keep pressing forward and moving on. So, back when I started in the industry back in 1999, we were writing unlimited policies that never, ever stopped paying benefits. We had the 5% compound inflation. Sometimes we had paid-up policies that paid for 10 years or paid up to age 65. Well, those days are gone. We don't have those available to us. So what are we out there talking to people? We have options today. 20 years ago, we would have thought we were giving a disservice to our clients by only talking to them about a 3-year benefit period. But what I want to share with you today is, we're looking at rebooting. We got to change. Change is inevitable. We have to change, go along with the flow. I want to share with you some data on, the average claims that are being paid out and the average purchases that people are buying today to give you a little bit of peace of mind and not be afraid to still have the conversation with your clients, because some coverage is better than no coverage. So, we talk about the doom and gloom of long-term care, but I want to give you some positive light that there are things that are still out there, and we got some good things that are still coming. The Great Recession changed everything. 2012 household income was slightly less than it was in 1989. The family median net worth in 2010 was $77,000. In 2007, it was $126,000. 75% have less than $30,000 in their retirement accounts. In 2007, and a couple could spend $1,982 for long-term care premiums. In 2014, that same couple was spending $3,800. So this all looks doom and gloom, but today, price is king. We always talk about cash is king. Well, price is king too. Buyers are younger. When I was doing this back in the 90s, we were writing a lot of people in their 60s and 70s because they were retired and now they were concerned about their extended health care expenses. Today, we have people younger. We have to continue to get them younger because of the underwriting declines up front, because people start developing health issues in their 50s. We commonly get blood pressure, cancer, health issues, cholesterol, diabetes is another big concern that people start getting, and we have to purchase long-term care. We have to have this conversation with our clients at an earlier age, because as we know, once you have those conditions, some of those conditions, it does become pretty hard to get coverage. Now, I don't want to paint gloom and doom forever. If you just diagnosed with diabetes and you can control it with some diet and exercise, you can apply, but you might need to have a period of stability, or they put you on a medication. We might need a period of 3-6 months stability before they could apply. Some companies may go 6 or 12 months. So I don't want to say never. It's a lot easier to get these people while it's health is not an issue. So we're going to talk about a little bit about the good, better way to get your approach. I kind of think of this as, if everybody had kids at one point in a time, they had their school pictures, you could take, option A, B, or C. Well, that's kind of what we're doing here. You can go get your tires taken care of and get a good service at $24.95. They're going to get their oil changed. They're going to get a few things done here. But if they want to pay a little bit extra, they'll get a little extra perks. If they want the best service, they're going to get more perks. And that's really what we're up to here. That's the change that we're seeing. That's the reboot that we are seeing as an industry. Some of our clients, they may want that super unlimited. They may want that best approach. They may have the money. They'll be willing to pay for that. where some of us still just need a good, solid product that will get us through the majority of our expenses. And there's nothing wrong with that. And that's probably the biggest thing that I want to get through to everybody is, even though we were so conditioned on having to have 5% compound inflation, unlimited policies, and, I'll be honest with you, if I could still get every applicant to apply and get them an unlimited policy, never ever stop paying, and 5% compound, unlimited, no maximum, of course I would want that. But I also recognize having a 3% product with 3 years of benefits is better than absolutely having nothing. So in age 60, pick one stock, pay for a fund. It'll pay off in 2037. Lock in a CD, it matures in 2037. You buy a car, won't drive till 2037. So we're always looking at today what we're going to need ahead in the future. And that's kind of what we're doing with this rebooting. We can get a good policy. It'll pay $164,000 of protection. We can do a good policy that's comprehensive, it's tax qualified, and it gives them $164,000 of protection. Why is that good? Because it's still helping that family member. It's helping the spouse. It's having the adult children maybe make sure that they can walk into a facility and have a pick of where they want to receive their care, or probably more importantly, making sure that if they want to hire home health care, they've got $164,000 that's coming from the insurance checkbook right up front. However, some of us will look back 30 years from now, or 30 years fast forward, and say, you know what, I want that $164,000, but I want the option at my discretion if I want to increase my benefits. So we can put inflation protection on that policy, where the insureds can be offered a letter every 2 years or 3 years, depending on the carrier, that says, hey, I've got this, $150 benefit, but cost of care has gone up. I'd like to inflate my benefits. I understand I'll pay a higher premium, but at this point in time, we can do that without being asked those medical questions. So the significance here would be you're locking in your client's health today. You're getting them something that's locked in, and then they can purchase more at their discretion. And of course, the better approach would be we put inflation on this policy. So we used to put the 5% compound. Most of those companies out there have 3% compound. Some have a 3% simple. Some have 4% compound. Some of them are meeting with partnership guidelines. They'll do that 3% compound every year until they reach 76, so that their policy definitely meets that asset protection piece under that Iowa Partnership Program. And anybody out there that's unsure of that Iowa Partnership Program, what does that really mean? Don't be afraid to contact me later, and I would be glad to help the discussion kind of refresh your memory about that Iowa Partnership Program, because I am a big advocate. I think that's a huge thing. The nice thing about, the best approach is we put that 3% compound, we put the 5% compound inflation in there. Again, the 3% is the new 5%. It's kind of like when I was back in the mid to 90s, we were writing 5% compound inflation. We maybe had applicants in their 60s and 70s. Well, today's client is in their 50s, and they're not taking 5% because the premiums are so much more expensive. The 3% is the new 5%. But because they start out with that $164,000, we put that 3% inflation. They now have $365,000 of tax-free dollars coming to them when they reach their mid-80s. Why do I put mid-80s on here? Mid-80s is, statistically the age we really become vulnerable, that we need to start cashing in and using those services. So again, when one of the earlier slides is talking about projecting out 30 years, you can have a good policy that will pay home care, assisted living. You got this benefit. You can do a better policy that you can have the option to inflate it, or we can do the best where we can just preload it in there and have it taken care of. And here's just kind of a summary of those benefits. Again, the better approach would be if they desired along the way every 2 or 3 years to purchase additional coverage. Long-term care insurance today is nursing home avoidance protection. I am consistently, when I meet with people want to stay in their home. Home health care is the driving force. What's interesting to me is, the nursing home room and board rates continue to go up every year like clockwork. We see the lowest rate of growth for home health care, which to me is really ironic because most people want to stay at home. I've had some people say to me, "That's just ridiculous, Rhonda. $6, $7, $8, $9,000 a month in a facility. That's ridiculous. How can they get by with charging that much?" And the real answer of it is because they can do it. They can charge it and they can get it. We don't have the kids living close by, or maybe if they do live close by, they're working. They're not volunteering to stay home and take care of their parents. So they can consistently keep charging those rates because they are getting it. And again, you're seeing here that the average cost for home care grows at a much slower rate than nursing home grows. Let's see here. I want to go back just a couple things here on average sales for 2014. So when I'm talking about what we used to purchase versus what we're purchasing today, the average person purchasing in 2014 just came out here. They're buying 40% of all policies that were written in 2014 purchased a 3-year benefit period. Okay, in 2014, 32% purchased a daily benefit between $100 and $149 a day. So I have people ask me a lot, "Hey, Rhonda, what are people writing today? What are we selling?" Again, 32% are writing a daily benefit, and usually those are in $10 increments from $100 to $149 per day. 28%, not too far behind it, was between $150 and $199 per day. Then it drops off after that. So again, the majority of those policies written are buying 3-year benefit periods, and they're writing between $100 and $200 daily benefits. And I would say in Iowa, that's pretty accurate. Iowa is a pretty affordable place to live. Cost of care is still relatively affordable compared to the east, the extreme east and west coast. But I will tell you, assisted living across Iowa, you're probably minimally starting out around $4,500. Now, there will be some exceptions. I know a couple places in the Des Moines metro, you could probably start in at assisted living with very minimum additional services at $3,600 a month. But on average, I'm going to tell you, you're probably running closer to $4,500 a month. Nursing homes are easily $6,000 a month. $200, $210, $215 per day, $220 per day. Memory care is our most expensive level of care, Alzheimer's, dementia, and that's when I'm hearing $7,000, $8,000, $9,000 a month. Again, 48% of our sales that were written in 2014 purchased a 3% compound inflation instead of a 5%. So that 3% is the new 5%. What was interesting is for years we had a lower elimination period. In the old days, we were writing 0-day deductibles or 20-day, 30-day deductibles. Today, we're writing 90 and 100-day deductibles. Again, that's a way to help keep our premiums down. 93% of the applications written in 2014 were written with a 90-day deductible. Just wanted to share with you the average person purchasing in 2014 was the age category of 55 to 60. So 55% of all the applications were in that 55 to 60 category. So I get that question a lot too. Rhonda, what age are people purchasing? I will tell you, worksite, when we go into employers that are offering long-term care, majority of long-term care in the worksite is a voluntary product. Simply with the Affordable Care Act, we've not had a lot of employers that are willing to pay additional dollars out for an employer-paid benefit. However, I don't want to tell you that none of it's going on. We do still have some of it. The worksite world, long-term care, did not take the bigger decline like the individual sales. We did still have some decline in the worksite. However, it wasn't as drastic as that 23% decline on the individual policy sales. The other thing I will tell you is shared care is almost 46% of all applications in 2014 obviously were couples. they put that shared care rider on there. That shared care rider says, you know, Mr. has his pool, Mrs. has her pool. They have access to share each other's benefits. So that's another way to help give that dual protection. So instead of having unlimited protection, they can share each other's benefits. So now that we've got kind of a little bit of the doom and gloom of, you know, that we've been hearing about, companies exiting the market, rates are going up, decline rates are going up, less people are getting preferred health discounts, premiums going up. You know, a lot of you probably been privy to gender-based rates. Last year, in end of 2013, 2014, all those carriers, we just have a couple carriers that have not switched over yet to what we call gender-based rates. So for those of you that have done life insurance for years, we had men paying more for life insurance than females because they were a higher risk of deceasing sooner. One of the big changes since these in-force rate increases is the actuaries have really revamped and changed what they're doing. The insurance commissioners really don't want those companies to be having in-force rate increases because they're designed to protect the consumers. So even though they allowed those rate increases to some of those policyholders and those insurers, they did go back to the companies and say, you know, what are you going to do going forward so we don't have these problems? So what the insurers have done is, number one, they have increased the premiums. They priced that 5% compound so expensive that pretty much it's pushing everybody to buy that 3%. And that's helping the company's long-term liability long-term. Another thing that we had was, you know, all actuaries have a margin of persistency where they anticipate that some people are going to purchase long-term care, they're going to pay into it for a period of time, they're going to drop it and cancel it. The insurance company gets to keep those premiums in reserve because they cancel their policy. They had a 5%, most of those companies had a 5% persistency rate. Now what they've done is they've changed it to 99%. So what they found was nobody was dropping their policies and they were not building, the insurers were not building up as much reserve. So one of the things that they've done now is they've changed those persistency rates to an assumption that 99% of all people who are going to buy a policy are going to hang on to it. Now, the other thing that's going on is companies are coming out with new products that can be a win-win, win for the carrier and win for the insured. I am proud to say and pleased to share with you a few things. John Hancock, back in, I believe it was March, April this spring, they did roll out their brand new product called Performance Care. And John Hancock is unique in the first product out there, the first company to do this. You know, one of the big things that we get, one of the big concerns we get from clients today is, what about rate increases? I don't want to have these enforced rate increases. Nobody likes to go back to their insureds and say, look, you started out with a $100 daily benefit, $150 daily benefit. Good news, you had inflation. You're up to $300 a day, $200 a day, whatever it is. But now you're going to have anywhere from a 12, 15, 18, 20, 25, 17, 58, 75% rate increase. Now, obviously, the carriers are required to offer the insured some options. If they do not want to pay those premiums, we can reduce their benefits down. As I've been doing a lot of policy reviews the last couple of years here, I will tell you I've had very few people actually cancel their policies because of rate increase. I can name 2 of them that I've had. Everybody usually overwhelmingly say, I'm so glad I have this. No, we're going to pay the rate increase. But
hey, Rhonda, this is Thursday. I'm sorry to butt in. We've noticed that on your presentation, it's stuck on a screen that just says questions with nothing listed else on it. Is that correct, or do you need to move forward? Okay. Well, I just wasn't sure if that was the end and you're just adding some, or if there were additional slides. So I just wanted to check in.
Okay. Yep. Honestly, I'm just kind of giving you some
perfect
updates, so I apologize.
Okay. No, keep going, because this is awesome information. I just had someone message me privately and said, hey, it was something, am I missing something? So I just wanted to make sure that we weren't missing anything. Obviously, the content's great. We just didn't know if the verbiage was supposed to be there. I will let you go on. Sorry to interrupt.
No problem.
So keep going.
So what John Hancock has done is they have come out with their new product called Performance Long-Term Care. They're the only company and the first company that have said we will show you when you're sitting face-to-face with a client, or you're having Rhonda sit with your client, and they say, well, we've heard companies have had rate increases. What happens if I have a rate increase? John Hancock can now illustrate specifically what happens if there's a rate increase. And they do this by a couple ways. We can go back and say, you know, if we have a policy benefit of $150 a day, 3 years, and if John Hancock's actuaries, if their claims come out to be, you know, more than 35% than the actuaries anticipated, and if the interest rates drop, like we had in 2010, 11, and 12, if those interest rates drop below a certain percentage, on the software, we can specifically show exactly how much their premiums will increase. So instead of surprising the clients later with a letter, John Hancock, with their new Performance Care, can actually illustrate what happens if we have a rate increase. If it's in this category, it will specifically spell that out. More unique with what John Hancock is doing is they have provided a flex benefit into this Performance LTC product. So a lot of you may like this that are used to long-term care, a lot of you that are used to life insurance, or I also think it's kind of a cross between life insurance and a health savings account. Basically, you're getting a flex credit account every year. When you make your premium payments, a portion of that premium is being built into a flex credit account with this John Hancock Performance product. In the event 5 years from now the claims are higher than the 35% anticipated and the interest rates drop lower than anticipated, and John Hancock says we are going to have this in-force rate increase that we warned you could happen, you can access the money out of that flex credit account to use towards that rate increase. You can also use it if you say, no, I'll just keep paying the rate increase, and if they decease and they never use it, the balance of that flex credit can be returned back to the beneficiaries. Also, if you do have a 90-day deductible, because it's a way to keep those premiums down, you can use access to that flex credit to help offset those upfront costs up front. What I want to tell you is, again, this is brand new. It's unique to the industry. The insurance commissioners in all the states are in love with this, but they're actually showing upfront specifically what those rate increases can be for the clients, and they have options. Number two, Genworth is just getting ready to roll out their same exact product. However, they're lowering their premiums. So to me, with John Hancock rolling out the Performance product, with Genworth keeping their products, can't really make a lot of changes to it, but they're redoing the rate structures on it. They're going to lower the rates down now that we've kind of made it through that bubble. They're offering that. That's telling me that these companies are still wanting to stay in the industry. These are the positive things that we have going on. There are to be 2 new companies rolling out long-term care. We've talked about companies exiting long-term care. This one is showing that's telling me that we're going to have 2 companies that are going to come out with brand new products. And then the other thing that we're seeing lots of traction on is these combination life long-term care. Now, I told you that the industry in traditional long-term care took a hit of 23%. Sales were down from 2013. The combination side, the life long-term care products, actually had a growth. So we're seeing more traction on those combinations. So to me, there's 3 different strategies when talking long-term care. One of them is talking traditional long-term care, which mostly everything I've talked about today is about that traditional long-term care. If you want somebody that wants the guaranteed asset protection, they want the partnership law, if they want the most long-term care benefits for their dollars, we're going to steer them towards a traditional long-term care product. However, some people are adamant. They say, I do not want to deal with potential rate increases. I want to guarantee my money back. We can look at these combination long-term care life insurance policies where they may put in a lump sum $100,000, $150,000, and they get a pooled money for long-term care. If they don't use it, maybe they can share it with the spouse. It's a joint policy. or if the spouse doesn't use it, then it becomes a separate pool money for life insurance. So they get a smaller pool for a death benefit. They get a majority of their benefit up front. We can do those in single payments. We can do them on a 10-year payment. We can also put riders on those. So if they do want an unlimited policy, you've got a $5 million farmer and he definitely wants unlimited, never ever stop paying, we have an option to go to. He can do a rider on that turns that 3-4 year benefit period into an unlimited benefit. So we have a strategy out there for those people. And then the other thing that we're getting lots of traction out of is life insurance, that you can either have the long-term care rider attached to it, or the chronic illness rider. Now, for those of you that aren't familiar with that, the long-term care rider is a true long-term care rider in the fact that it will say, you know, your physician says you need 2 of the 6 physical activities or cognitive impairment minimally for 90 days. What I want to draw your attention to is I get a lot of question on what's the difference between the chronic illness rider and the long-term care rider. The chronic illness rider, the critical illness rider, the downside on those riders are the verbiage says that your insured has to need assistance with this condition permanently until death. So a lot of times those policies, the life insurance with the critical illness or the chronic illness rider, they can be a little bit less monetary-wise because they're not going to be paying as much up front. Where the traditional long-term care just says your doctor's got to certify that you need care minimally 90 days plus. So they can be intermittent, go in and out of care. And of course we get in there with different carriers, have, you know, maybe a residual death benefit even if they do exhaust it all up. So, you know, we get into different carriers, have different perks, features, options. But I would tell you, in general today, we've got 3 options going forward. I'm still a firm believer if you want the most long-term care benefits, you're going to go to a traditional long-term care policy. If you want a little bit of guarantee and guaranteed short-term premium payments, then we look at this combination long-term care life insurance. And if you want the least long-term care benefits, we look at the life insurance with the long-term care riders attached to it. That's kind of my quick notes on where we're at. I'd like to turn it back to Darcy and see if we have any questions or anything I can help be of assistance with at this time.
Awesome. I just sent out a message to everyone. If you have a question, if you want to either raise your hand in the little grid there so that I know that you've got one, or just send a quick chat to me and let me know I got a question, I'll unmute you, and that way you can ask your question in a little bit more detail than typing it in. So we'll wait here for just a minute. I did have someone message me and ask if this webinar will be out online, and it will be. It'll be out online tomorrow. In fact, I'll be caught up tomorrow. As with all of our webinars, we put out the actual webinar. We put out a PowerPoint in a PDF format, so you can easily download that and look at the slides. And then we also have just recently started putting the audio files. We've had several ask for that, so they can listen to it while they're in their vehicles between appointments. So all 3 of those options are available out underneath the resources on the KHI Agents website. So if you have a problem getting any of those downloaded, please reach out to me at marketing@khisolutions.com and I can help you with that. Right now, I don't see anybody's going to raise their hand and ask a question.
Darcy, could I interject?
Just a second. I got one here with Deb. So, Deb, I'm going to unmute you. All right. So, Deb, do you want to go ahead and ask your question?
I would just put Marianne L. Peterson and leave off the trustee, because your bank's going to know it's got trustee on there.
Deb? Okay, I just muted Deb. I'm not sure we were supposed to hear that. So, Deb, I showed that you raised your hand with a question, so if you still have a question, let me know and we can get you connected with Rhonda here. You can see Rhonda's contact information on the screen. Feel free to reach out to her at her office or by emailing her. As she stated earlier, we have a really good relationship with her and her organization there. So feel free to reach out and utilize their services as you need. So I'm sorry, Rhonda, I cut you off there for Deb. Yeah. So did you have another point you wanted to make?
I guess I'd like, if you guys have any takeaways out of today's, I know I shared a lot of information, and I apologize, maybe not all of it was on the PowerPoint, but I did just get some new updated stuff here over the weekend and wanted to get that into you. I wanted to like to share with you is don't be afraid to still bring that question up to your clients. I always call it the Columbo close. When you're doing a policy review or you've got a client in there talking about their aging parents or have a family member, simply just ask them, who do you have your long-term care insurance policy with? It can be a non-threatening question, and just say, if they don't have it, we really need to have this conversation. I don't want you to be afraid of where the industry is at, because the need is still there. And what I'm hearing, even though these policyholders have had these rate increases, they are keeping their policies, and they are so glad they have it, and they will continue to pay the premium increase because they know the amount with their premium increase they cannot beat starting over today. So even though you have a company that exited the market, they're still paying those premiums and servicing those policies. So don't let that deter you. If you're afraid of they may have a potential rate increase, again, we've got John Hancock coming out with an option. We've got the combination product. If you're saying, Rhonda, I don't like it, we can't get unlimited benefits, we have option 2. We can look at that. So not one strategy is a perfect fit for everybody, but we do have different puzzle pieces that we can really kind of zoom in there and help figure it out. And that's where if you become uncomfortable with it, you have access to partner up with me, in one way, shape, or form to make sure that you're doing the best interest of your clients. So I want to give you a little peace of mind. Sure, I'd like to tell you everything was the same it was 20 years ago. It's not. I can't do anything about it. You can't do anything about it. But the need has not changed. If anything, it's a bigger need. It's even greater need today. So don't be afraid to still be asking your clients. The other thing is, if you do find out your clients do have a policy in force, I have another agent that retired, and he's like, Rhonda, I just want to make sure my people are being serviced. Will you help me with that? By all means, don't be afraid to say if they do have a policy, let's have it reviewed from time to time. Make sure that they're up to date on what their policy is covering. Does it cover home care? Did it have inflation? Not that we're going to do anything with it, but just need to make sure that they're up to spec on what they have for benefits. So you're welcome to utilize me if you need any help with some of that verbiage or questions.
Excellent. A couple of points I wanted to make real quick before we're done here is our next webinar will be on August 14th at 9 o'clock. It's our monthly healthcare reform webinar, so you want to make sure you get that on your calendar. And then on Monday, the 17th, I'm going to be conducting for the Marketing Monday webinar, we're going to talk about discovering your why. I don't know if many of you have heard of the why, but we're going to talk a little bit about what truly differentiates you from the guy down the street and how you can discover what that is so that you can use that in the way that you go about your business and your branding of your business. And it's actually something that transcends not only from business but to your personal life as well. So it's a little bit of a different take on the marketing. We're not going to be talking web. We're not talking social media. We're not going to be talking promotional merchandise, but it's something that is starting to gain a lot of interest. A gentleman by the name of Simon Sinek has started this whole new mindset with his book, Starting with Why. And so I want to spend a little bit of time talking about that and share a little bit about what we've done at KHI to discover what our why is, and hopefully you'll agree with us as I share that with you. So that'll be on Monday the 17th, and that's from noon to 1. So we encourage you to grab something to eat and join us. Typically they run about 30 to 40 minutes, so it's not a full hour. And again, it's dependent on questions that come from you as well. So Rhonda, thank you so much for joining us today. It was awesome information. I learned a lot. I hope those that were on the call did as well. Again, this will be out on the KHI Agents website starting tomorrow. So you can hop out there and re-listen to it and look at the slides. If anyone has any feedback on the webinars or topics that you'd like to see covered, feel free to reach out to anyone of the KHI team, or you can even send me an email at marketing@khisolutions.com. And with that, I hope everyone has a great day.